Would you like to double or even triple your profit potential so that you can make 2 to 3 times more on the same basic trading idea? It's possible with options, and in this video, we're going to teach you how. I'm Seth Freudberg, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You found the right place to learn. Anyone out there interested in trading knows that tech stocks have lost a great deal of value over the last month or so, and there's some sentiment building that this is getting a little bit overdone and that a bounce is due. And as most of you know, this sell-off is evident in this price chart of the ETF known as the Qs, a basket of the biggest tech stocks, where after hitting its all-time high of 540.81 on February 19th, it has tumbled with very little interruption, trading at 473.63 on March 18th, a month later. A loss of over 12% of its value in a single month. That's a huge drop for such a short period of time. And so there's some folks out there who see this not as a disaster, but rather as an opportunity, a chance to scoop up tech stocks for a sale price. And if this sentiment grows, a bounce in tech stocks would be the natural result. And so if a trader were to become bullish on tech stocks, they obviously could just go out and buy shares of the Qs, right? But I'd like to suggest to you that there's a better, more powerful way to express this trading thesis where much more profit is available to you with less risk than buying the Qs or any other tech stock. And that is what today's video is about. So if that sounds interesting to you, then stick around because I think you're going to find this intriguing. Now, before we get into the options trading strategy that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. In order to help you to understand how this strategy works, we're going to share an analogy with you from last summer when a very similar sell-off took place in Amazon stock, one of the components of the Qs, a sell-off which started on July 10th and continued into early August, losing over 16% of its value in a little over 3 weeks. A pretty fast drop, similar to what we've experienced just recently in tech stocks in general. And so obviously the easy thing to do if we thought a bounce was coming in Amazon, as we said earlier, would have been to go ahead and just at the closing price of $167.90 that day, we could have just bought 100 shares of Amazon for that price, spending $16,790. But there's a better idea, and that is to use the power of deep in the money call options to express our directional viewpoint on the stock. So let's say that we had a view that the stock was getting ready to bounce, but that the bounce was likely to play out over the next 6 months. So we instead went ahead and pulled up an options chain expiring on February 21st of 2025, which is a little more than 6 months out, matching as best we can our time frame. And instead of buying 100 shares of stock, instead we go to the call side of that options chain and pick a call strike price that is more than 47 points below where the stock is trading, the 120 call option strike price. And we go ahead and buy 3 of those options for a price of $53.80. And when a trader does that, he's entering into what options traders refer to as a synthetic stock position, which will perform very similarly to the way that 300 shares of a stock will perform, yet we can acquire them at a much lower price than buying 100 shares of Amazon. Now, how's that possible? Well, let's take a look more deeply at the cost of these 3 call options. You see, when you buy a call option for a price of $53.80, you have to remember that each call option relates to the right to buy 100 shares of a stock at the call strike price. So you have to multiply that price by 100. And we bought 3 of them. And so the total cost of these 3 options is $15,900, which is less than what you'd pay for 100 shares, as we just showed you. Now, before we go any further, you might be wondering why we picked that 120 strike. And the answer lies in what options traders refer to as the delta of an option, which is a mathematically arrived at prediction of how much the options price will go up if the stock from which that option is derived goes up $1. And so you can see, looking back at that options chain we just showed you, the delta of the 120 option is 91.02, which means that the mathematical model is predicting that if Amazon goes up $1, the options price will go up a little more than 91 cents. Not quite $1, but pretty close to it. And in fact, if Amazon were to rally, the options delta actually goes up closer and closer to 100 cents on the dollar. And the implications of this are huge, as you're about to see, because if we move to the day that these 3 call options expired, as you can see, Amazon had rallied since last summer into 2025, peaking at 242 before selling off down to 216.58 on the day that these options expired. And so instead of ponying up $36,000 to actually exercise the call and acquire the shares at $120 per share, if we were to go ahead and sell those calls right before the close that day, as you can see, they're priced at $96.72, which makes sense, right? Because the 120 calls give you the right to buy shares selling at $216.58 for $120 per share. And so naturally, the price of that right, that option, is going to be very close to the difference between the stock price and the discounted price at which you are entitled to buy the shares, which explains why that option's worth $96.72. Which is almost exactly the discount you'd get on the shares if you actually went ahead and exercised those options and acquired the 300 shares. And so rather than having to come up with the cash to actually exercise the shares, the $36,000, we're just going to go ahead and sell the call options instead. And so let's do a comparison. If we sold the shares, the 100 shares, that calculation is pretty easy, as you can see, with the profit being $4,868, which is a return of 29%. But if instead we went the route of buying the call options originally, as you can see from the calculation, our profit is way more, $13,116, with slightly less starting capital, by the way, of $15,900 versus the $16,790 that we paid for the 100 shares. And so it's no surprise that the returns on the calls blow away the returns of the shares, although both are obviously solid. Now, it's important to note that when buying 3 deep in the money calls, you're economically very close, as we said earlier, to owning 300 shares of Amazon, although for a much lower price. Because those deep in the money calls, as we mentioned earlier, move almost like 300 shares of stock move because the deltas are so high. So if Amazon were instead to have sold off instead of rallied, the shares would have lost value more slowly than the 3 call options, although the pace of that value loss would slow a little bit as the stock went down for reasons that we can cover another time, but just suffice it to say that as a stock moves down, the deltas of its call options move down also, meaning a sell-off's effects weaken a little bit as the sell-off continues. But in any event, you can expect a bigger loss on 3 deep in the money call options than with 100 shares of stock, all other things being equal. So that is the downside of using this approach. So what I'd like you to take away from today's video is that through the use of deep in the money call options, traders can massively increase their profit potential on a stock's move if you get that move right. And that's because deep in the money call options are so much cheaper than buying shares that you can buy, as in this example, 3 options for every 100 shares you own and conceivably spend less than you did on the 100 shares. Yet, as we explained, because of the very high deltas of deep in the money calls, owning 3 call options is in fact very close to owning 300 shares of a stock without actually having to shell out what would have been, in this case, over $50,000 to buy 300 shares at the outset of this trade. Instead, you only risked $15,900, less than a third of that, and ended up making way more than you would have with 100 shares. That's a great example of the leverage that options traders can exploit, and if used intelligently and judiciously, can be a great way to multiply the returns of the trades and investments that you make personally.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money, whether the market goes up or down or sideways, and how to make money on a stock or index trade, even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.